right on the we'll jump right into it on the whiteboard today. We'll do a little game plan here. All right, so when it comes to bias, right? Bias is what I like to think is one of my stronger points. And it's not anything magical, as I always say. It's coming and approaching bias from a systematic standpoint. All right. And one of the key things to understand when we're trying to frame bias, right? Because once you understand the market is going to go up or it's going to go down. All right. We just have to understand that from a very fractal sense. All right. And that's understanding the higher time frame objectives and how that correlates to that intermediate time frame, and then how that correlates to the smaller time frames, those intraday time frames. All right. So the very first thing that I always ask myself is, are we in the buy or sell program? All right. And obviously, we know at this point, there's buy and sell programs within buy and sell programs. All right. But we have to understand the overall picture. All right. So when I ask myself, am I in a buy or sell program? I'm also sort of asking myself, what's the current state of institutional order flow? Okay. So when I look right here, if I'm looking at this chart, and I have this 3 because that's symbolizing a quarterly chart, and I always start on the quarterly chart. Okay. But when I look at this chart, I'm seeing that institutional order flow, right? These up close candles, you can see IOF here, IOF here. That is what is supporting price, right, at the very moment. And just for sake of longer timeline, we might have seen price traveling from here. All right. So right away, I know that order flow on that quarterly chart is bearish. Okay. And I can look at this range. I can go through rapidity arrays and things of that sort. Right. Obviously, we also understand that price is moving stops to inefficiency. So we'll imagine that maybe we ran out some stops here, and now price is potentially wanting to rebalance that range. So, but the biggest point is we understand that right now, all right, we're on the sell side. We'd be on the sell side of a curve. Okay. So these, this may be like this may be a redistribution if we were to zoom out. Okay. Preparing for another redistribution up in here. All right. So right away, I understand we're on the sell side of the curve, right? On the quarterly chart. However, I have to also understand that when I measure this quarterly range, right? If I go, we can go from this high down to this low. I'm going through my PDRA matrix, and I'm noticing that I have a mitigation block here, right? And then I also have an inefficiency here. All right. These are 2 major or significant areas that price could draw to and then reprice away from. All right. Because I know in my mind that price trade stops to inefficiency. Okay. So now when I look at my quarterly chart, order flow is bearish. When I look at my monthly chart, right, because we're traveling up to that premium array, these candles here are resembling 1 month. When I look at my monthly chart, order flow is bullish, and that's only because price is repricing up to higher time frame objective. Okay. So order flow on the monthly chart, right? We've gotten that. It's bullish, right? On the quarterly chart, bearish. Okay. When I look at my weekly chart, we'll come down into here. But looking right here on the weekly chart, each one of these boxes is resembling a weekly chart. Okay. So for right now, the draw, right, or the order flow in terms of the weekly, right, would be bearish. Okay. And we can see here inside of these weekly candles, these are, the ones inside would symbolize daily candles. All right. So those guys are bearish too. However, we understand that this smaller time frame, and I'm saying smaller in reference to the quarterly chart, but we understand that this is a bearish movement, right? This bearish movement is more so just a short-term retracement to the extent of this higher time frame point of institutional order flow. All right. So the draw of liquidity for this little segment of time may have been previous days low, previous weeks low. Okay. So every single week that you were looking at price right here might have been open, high, low, close, open, high, low, close, open, high, low, close. All right. So I understand order flow. I understand which side of the curve I'm on. I'm on the sell side of a curve. All right. And then I also understand the relationship between the order flow as it relates to quarterly chart, right? Monthly chart, we're headed up. Or monthly chart, we're headed up. So that order flow is slightly bullish. All right. Weekly chart, we're retracing into a monthly point of reference. So that weekly chart is short-term bearish. And then of course, daily chart is going to flow in line with that weekly chart. All right. So now that I understand all of that, I'm going to look at my ranges. All right. And the reason that I want to look at ranges is because market maker models form within defined ranges. So every time I have a range, right? Once I understand order flow, I understand the relative correlation between all the time frames. Now I'm going to take that parent price swing, right? And by parent price swing, I'm going to reference this overall swing here from that high to that low. I'm taking that parent price swing, all right? And I want to know where my PD arrays are, right? So I'm going through that PD array matrix. Okay, and the reason that I want to go through that PD array matrix, okay, we may have fair value gap. I'll draw these in different colors. We may have fair value gap. All right, we might have a mitigation block over here. We might have an OB here, right? And then obviously old high, right? But the significance is once I have that range, I have to understand that market maker models will form within defined ranges. Simply put, because price has to go from discount to premium and then from premium back to discount. All right. So if I have my fair value gap, my mitigation block, now these become gauging points. All right. This array up above, or this area where these arrays overlap, this becomes a reference point for us. All right. At least we know that for this overall range on this quarterly chart. No, second, I have issues. All right, 1 second, guys. All right, back in business. Share. All right. So once again, we have this range, okay, and then we understand that this is our major point of reference for this overall range. So at this point, right, we're basically on the buy side of that curve, right, from an intermediate standpoint, but from the larger perspective, because order flow is higher time frame bearish, right? I know that I'm on the buy side of the curve, but it's for a shorter extent of time. All right, up into that fair value gap or that premium array. Okay, so once again, market maker models form within defined ranges. All right, and once we have the range defined, then we'll start understanding at what phase we are within this market maker model and then how that relates to price pushing into a key level. All right, so now that at this point, right, we're on the sell side of a higher time frame on a higher time frame curve. All right. But from this intermediate standpoint, we're on the buy side of a sell program. All right. On the buy side of a curve on a sell program, and we're looking at the intermediate time frame. Okay. So now once we come into here, go back. All right, once we come into here and we're looking at price, we know that the draw of liquidity from a monthly standpoint, right? If we're looking at these, these down close candles, right? And obviously price would be drawing on the previous month's highs. So once it comes to framing the draw, all right, when it comes to framing the draw, I always say price is going to take out previous intervals high or previous intervals low. All right. And the reason I say interval because it's all fractal. All right. So what I mean by that is when I come into a month, if I'm looking at a monthly chart and the previous months have been drawing on previous months highs, on that previous month's highs, I'm not going to be the one to pick a top, right? I'm going to come into that next month or that next interval, right? It could be weekly, daily, right? Doesn't matter. I'm going to think that price is drawing towards that previous, we'll just say month here, previous month's highs. All right. I'm never going to pick the top and say, all right, it's time to reverse. So, key point, if the draw is above market price, all right, the draw is above market price, that means you guys always hear me say protocol. The draw is above market price, then you're going to have an open, low, high, close protocol. Okay. If the draw is below market price, you're going to have an open, high, low, close protocol. All right. So when we're looking at this little segment of price and we're saying, all right, what is the draw? Well, let's frame the draw for this month. Basically, when we're framing the draw, what we're saying is, what is this monthly candle more prone to look like? Where is this monthly candle going to expand to? Okay, range expansion. All right, which I have right here. So where's this monthly candle going to expand? It's going to expand higher. All right. Well, now if it's going to expand higher, we have to think in terms of power of three: accumulation, manipulation, distribution. So that means that my protocol is open, low, high, close. Right. This monthly candle, Lando, can we mute that person? So this next monthly candle is going to be open, low, high, close. All right. Now, when we're saying open, low, high, close, or open, high, low, close, what we have to be mindful of is when we're saying low, open to low, basically what we're saying is low means price pushing into discount array. All right, because we're saying that low, that's going to be a pivotal point. And that low is obviously is going to be created off of some type of discount array. All right, meaning inside of the range of this previous monthly candle, maybe there was displacement here, right? Came higher and closed. So what we're saying when we're saying this next candle is going to go open, low, high, close, we've potentially spotted some type of array inside of that previous month's candle, right? And we're saying that that's going to be that reactionary point. Okay, so open, low, high, close, price opens for that week. All right, we may have the first week of the month. It may be us around. Second week may give us that Tuesday or Wednesday reversal. We'll go back and we'll talk about the daily profiles or weekly profiles, right? And then we see the rest of that candle create as it runs through the high, right? And then we don't know, what else is going to do from there. All right. So open low means discounted rate. When we reference the high just means where the actual draw of liquidity is. All right. So if the draw is 0,500, right, what we're saying is it's going to go open low to the fair value gap, and then it's going to rally to that actual draw of liquidity. All right. So keep that in mind. Talk about power of three. All right. So open, low, high, close. All right. So now once we understand, once we framed out, all right, we know for this month, this whole month, the draw should be higher. All right. But we know that this monthly candle has to manipulate to some degree. All right. So now we understand there's going to be 4 entire weeks within this whole monthly candle. Okay. But we understand that the sweet spot is at this discount rate. All right. And then we have our opening price for that monthly candle literally right here. So as the trader, as we come into this month, order flow may be bullish, right? However, however, it may be productive, right? Or doable to take shorts because we understand that price wants to get lower into discount arrays, all right, to create the low of that monthly candle. So we may be shorting down into that discount array, all right, for maybe the very first week of that monthly candle, right? Or even the second week of that monthly candle, right? However long it takes to get us to that discount array, right? And we want to be under the monthly opening price. Okay. Now, let's take that understanding, and then we're going to come back over here to a more defined image. All right. So we're here. We see these weeks right here. How we know that the actual draw, right, or the low resistant liquidity run should be back to these highs, right? Every single high, right? There's been a draw on every single high. Every time a high is created, right, that becomes a low resistant liquidity run. When price trades back down, right, as we get closer to this point of order flow or this point of reference, right, this becomes more of a high resistant run. And then we want to know, if we want to always know, right, am I trading in the low resistant liquidity run scenario or high resistant? Now, all that means is, as price is going down and we know that it has to attack this discount rate, if you're buying these moves here, right, you're buying the higher resistant liquidity run. But if you were shorting, right, you would be trading in the low resistant liquidity run, right? Because price is not so protective of these lows. All right, it wants to make it into this discount rate. But once we start getting closer to that array, we understand we need to kind of hold off a little bit. All right, this is where maybe we start wanting to sit on our hands. We might get down here and see some type of consolidation or something of that sort. All right. So what we can see right here is that this week, right, this is a previous week's low, right, hovering above discount array. So once we come into this next week, all right, we may still be thinking, all right, price, this may be open, we may see open, high, low, close, and we're only going to say that because of the consistency. But we still understand, all right, we're approaching this higher time frame discount rate. This could be a reactionary time for price. Okay, so the very first week, let's say that this is the very first let's say this is the very first week, right, of this month. All right, this may be a consolidated week. All right, and actually let's pause and let's go to the profiles. Yeah. All right, so we'll look at the intraday templates first. I have to show you this before we like make up the whole little narrative here. All right, so profiles. All right, introducing the intraday templates. When it comes to the profiles, I always say there are three primary profiles. All right, and the other three are just kind of spinoffs of the main three. All right. So the very first one, which is my favorite. This is more so what I wake up and look for every single day. You guys will learn about the characteristics that kind of give you the tip off for if it's going to be a classic buy or sell day. But this classic buy or sell day is basically just a continuation template, right? Where we have a Judas swing down below. All right. So if you're seeing the opening price here, for those of you that don't know, right here, this is referencing, right, midnight EST, right, opening price. Right, we see that Judas swing, failure swing here. We rally. We get into New York CME. We have that OTE move, and then we have our continuation to finish off the draw of liquidity for that day. All right, this is the inverse image here. Okay, a few examples. Judas swing dropping under the daily opening price. All right, we rally higher. Okay, and then this is a day where we don't really get the OTE move, but price makes it up to the draw. All right. Better example here of the retracement in New York, right? OTE. This is the simplest way to trade New York. Just looking for that OTE move, right? We have our Asian range. Price takes both sides of Asia, and then we come back, discount array, And then there's that speed. Right. I guarantee you Model X is right inside of there. All right. The second profile is the ICT London swing to Z day. All right. That swing to Z day. You'll see this profile primarily on a Monday, right? Or even a Friday if the draw has been met. Okay. So why would this happen on a Monday? Because this could be a scenario where discount array is here, right? And then we're having Monday like this, just hovering above the discount array, basically creating a short-term low to allow Tuesday to maybe give us a swing to reversal profile, which we're going to see next. All right. So the Z day is more so a day where it's just a range like day, consolidating day. Sometimes it'll start out like a classic buy day. Then you'll get that retracement. You'll think you're getting that expansion, and then it'll basically just fail. So Z days will hover around that daily opening price. All right. Here's examples here. You can see opening price. We're not moving too far away from that opening price. Same idea here. Okay. All right. So now we have the ICT London swing to New York Open London close reversal day. All right. This profile, you'll get this profile. Let's say we have this is say this is the stage that we have set. All right. And these are daily candles. This is a fair value gap. You've had a Monday. All right. Monday Z day. All right. However, you're in a week where the draw is attacking previous week's lows. Okay. So Monday hovers, creates short-term highs. Now you're expecting price to travel into the premium array up here, which is the fair value gap. We open, set the intraday low in London. We rally higher into the premium array, right into the New York Open kill zone. And then there we go. All right. So think about this, right? Think about the whole narrative that's just played out here, right? We had price attacking previous week's lows. We have our Monday Z day consolidates. Tuesday rallies up into the fair value gap, gives us the swing, ICT swing to New York Open London close reversal. All right. Now, if you look at what's happened on these 2 days, this is a dealing range, right? So then we come back for Wednesday, because we have to rebalance that inefficiency. Wednesday may give us a classic sell day. Judas swing into the array, drop lower, OTE in New York. Boom, we just made it through the draw of liquidity for that week. All right. And then Thursday and Friday, depending on what's happened, if the draw is met, you may see Thursday and Friday, those guys may be smaller range days or something of that sort. All right. But primarily the Z day is that reversal day. Right. Key characteristic about the Z day is you want price to be meeting the array at the time of the New York Open kill zone. So around 7 a.m. Doesn't mean it can't happen at 8:30 and then reverse. But just be mindful. It's when New York is actually rallying into the array right at the New York Open. All right. And then the other profiles are simply spinoffs of the ones that we just saw. All right. So the ICT range to New York Open London close rally day. This is the day where maybe you have FOMC, all right, and London hovers up into the release. All right, so this may be London Open kill zone. We get to New York Open, it takes London low and then expands. All right, but it's just like a classic buy day. There's just a range before the expansion. All right, so you can see here, range before the expansion, and then we have interest rates. All right, right here, London ranges before the expansion. All right, we get to New York, London low taken out, and then we expand. All right, a lot of times you'll see SMT in those scenarios. All right, ICT consolidation rate on news release. This is really no different than the range day. All right, same idea. We're seeing New York primarily run out the consolidation of that day and then expand. right? And then last but not least, the the worst one is the seek and destroy day, right? Where you'd rather have taken that first loss and just got out of there. All right, seek and destroy. There is no direction. All right, this is a day where there's a move being set up for a another day to come. All right, and you're seeing no set direction. Order flow is not carrying over. All right, we've actually solved this scenario from a larger scale. All right, in terms of us looking at EU and DXY, seeing price just kind of move back and forth, take out highs, take out lows, and get right back inside of the range. All right, very frustrating. All right, so those are the daily profiles. All right, so let's go back here and let's kind of map this entire thing out, because as the trader, we understand where we are. All right, so we're coming into this next week, and for this next month, all right, monthly candle, and we see this very first week gives us more so of a consolidation on Monday. All right, and then we get to Tuesday, and we know where we are from the overall image, right? Because we want price to run down into here, just to add it, make it a little more realistic. Let's add a fair value gap. All right, we have the previous week's low. Previous week's low has set that short-term low. This is our previous week's low. All right, we know that this is a key area that price should reverse from. We also know that from an intermediate standpoint, this is a buy program. All right, but we're expecting this to just be the reaccumulation. If you look at these orange boxes, this to be the reaccumulation to send us up to the higher time frame objective. Okay, we open up Monday, we have a Z day. All right, Tuesday takes us and rallies down into the fair value gap. All right, and then we have more of a swing to reversal day. All right, so at this point, there's Monday. All right, and then there's Tuesday. Okay, so we just saw a short-term low taken, right? Price runs previous week's low, and then trades right back inside of the range. All right, so we ran previous week's low, and we trade right back inside of the range. All right, taking out Monday's high, right, or the intraday high from Tuesday. So now we have a bullish dealing range. All right, and then we're sitting here, and we have the lower time frame fair value gap right here. All right, what we've also just saw is obviously there's going to be an up close candle right here. All right, we just saw that got taken out. So short-term low, we run into the inefficiency. We're seeing that as that intermediate term low created on Tuesday. All right, and now we're thinking about Wednesday. All right, we sitting here with this fair value gap. We know that the draw should be much higher. All right, this is now the low resistance liquidity run, and we're headed up here. Okay, so we can expect a more extended price run. But we're on Wednesday, and we're sitting here and we're prepped for that Judas swing. Why? Because now price is attacking previous day's highs. All right, so we took out Monday's high. That was a previous day high. And then we should be attacking Tuesday's high, which is also a previous day high. All right. But then don't forget, we also have this previous month high up here. All right, which should be the overall draw. Okay, so we got Monday. We're coming into Tuesday, I'm sorry. And we want to think about the protocol at this point. All right. So what should be the protocol as we're going into Monday? You guys can put it in the chat. Should it be open, high, low, close, or open, low, high, close? Okay. Yes, perfect, perfect, perfect. All right. Now open, low, high, close. So I want you guys, since we're saying open, low, let's define what that PD array is. What is the PD array that we're potentially thinking that price should hit and give us some type of reversal from? Fair value gap. Cool. Breaker. Yeah, I like it. Good job, Anthony. Perfect, perfect, perfect. That would be the response. All right, breaker. Cool. Let's get it. All right, cool, perfect. Right. So we're framing a Judas swing, right, off of that fair value gap, and we understand what the draw is for this particular date. All right, or what the protocol is for these particular days at this point. All right. What type of profile could we possibly get on this day now that we've taken a look at our profiles? What type of profile would you guys expect to see? And actually tell me this first. What was the profile that we had on Tuesday? Right? Because Tuesday dropped lower, New York session rallied into the array, and then we had this move here. What was Tuesday's profile? Swing to reversal, right? Perfect. And what makes it a swing to like what's the significant characteristic that makes it that swing to reversal? What time should we be seeing price run into that array? New York open. Cool. Cool. All right. Exactly. Right. London starts to move. New York. All right. So now here we are. Wednesday, right? What type of day are you guys expecting? It's possible. I like this answer better. All right. Classic buy day. All right. Cool. Classic buy day, right? So we're here. We have our Asian range, right? Midnight open. Judas swing into the fair value gap. We rally higher. New York comes here. The draw has not been met. Boom. Classic buy day, right? We rally off the high and then we close. So we got Monday, Tuesday, that's Wednesday, right? You can see the dealing range. One, we had two, three, right? And then four. So now we're on Thursday, all right? We're coming into Thursday. Nothing's changed. Draw of liquidity is still this point. We're attacking previous day's highs. That protocol, as we come into each day, the protocol is previous day high, right? From that point, I'm taking the same approach. I understand now on this little smaller time frame or intermediate time frame, I understand that we're on the buy side of the curve now. All right, we're on the buy side of the curve. Down close candles, we may be seeing 4-hour down close candles, right, relative to this time frame. We may be seeing 4-hour down close candles, right? These guys may be supporting the direction of price. All right, so you guys should be starting to see the trickle effect here. All right, now 4-hour down close candles is supporting price. All right, we're coming into a new day. Draws above market price. We're thinking the same thing. Always open, high, low, close. All right. All right. This could be maybe it becomes a Z day. All right. Who knows? And then we get into Friday. Same thing. Open, high, low, close. We're wanting to attack that previous day's high. Friday may actually give us a range. I mean, an extended range. All right. But we've just framed out an entire week. All right. We had a Tuesday low of the week. Key point. Every time I come into a week, I start off with my mindset always says that, hey, I'm looking for some type of narrative that is built around Tuesday or Wednesday, creating the higher low of week. All right. That does not mean that this will always happen. All right. Does not mean this will always happen. All right. But what it does is it gives me some type of foundation. I'm always thinking, all right, Monday, once I see the range, all right, I know the range and I know where the array is. I always think, all right, Monday, I want Monday to be like a BS day because it saves room, time, and price. Then I can allow Tuesday, maybe Tuesday stops just shy of the array. Then I got Wednesday, low of week. All right. Every time we come into a week, once we have the range, we're thinking, about the market maker model, thinking about the array, and then we're thinking, hey, Tuesday or Wednesday, higher low of week. Now, if you get into the week and you get to Monday, all right, and Monday is in a rush to get to that array, if Monday is a big range day, more times than none, that Monday will set. That'll probably be the low of the week. All right. If Monday is a big range day, a large range day, and it seems to be in a rush to get to the array, all right, then you may see something like this. All right, let's say Tuesday may give us a failure swing, and then we start rallying higher. All right, but so as you guys are trading this, that order flow on that 4-hour chart is bullish, and you're constantly trading in line with that order flow. Guess what? You understand what the overall objective is here, and then you also understand what the overall objective is here. All right. So as we make it to this point, say we keep going, all right, and we make it to this point, then at this point, you guys should understand how to then start framing this. All right, because now we were seeing these previous months highs taken, right? But then price gets up here to the higher time frame objective. Now you guys understand that pricing sequence to then want to start seeing things change over. So what would have happened up here is price would get up here, and then we start seeing previous candles lows taken. All right. So on this side of price, once price makes it up here, we'd be telling ourselves, all right, now we're on the sell side of a curve in a sell program, right? Larger, and we're in line with the larger time frame order flow. So guess what? This becomes the overall draw back to that low. All right. Let's just putting all the pieces together. So now that we're on the sell side of a curve, let's go and let's look at a live chart example. All right. So this is September of 2021. Okay, let's go back to stop this right here. Let's go back to a monthly chart. All right. So on this monthly chart, okay, what I'm seeing is that the draw of liquidity is previous candles low. Okay. So the draw is previous candles low. That means that for every single month, the draw is below market price. My protocol should be open, high, low, close. Meaning that I'm expecting that next monthly candle to give me a sale program from this open to that high into the array, and then turning around. So I'm looking for that smart money reversal, right? Because once we get on this side here, low resistance liquidity run. All right. So this is August. Now let's go. Let's see if we can. All right. So all right. So this is August. This is the 30th of August. But what you have to understand is that down in the daily chart, that candle just starts on the 30th of August, but then you got September. So it's really the September candle. All right. So if we frame out the opening price of September, which is here, opening price of September, this would be the high of August right here. All right. So we're going through our arrays, right? I'm looking at a previous month's high, and it's already showing you that it taps it. Previous month's high, we might have thought that price would trade into fair value gap. I don't know if it does. Maybe it does. Yeah, just barely, right? So barely gets into the fair value gap, but those would be our arrays. So we'd be looking at price from the open. We'd be looking at price from the open. We're going through the current range here to here, and we're seeing that, all right, cool. Premium array, old high, fair value gap. All right, and then all of this here would be a mitigation block, this whole candle, right? And we're probably right around 50% of that mitigation block. Okay, so back down into a weekly chart. Look at what's happening in the very first week of the month of September, right? It's trading above the monthly opening price. We're thinking about accumulation, manipulation, and distribution. So we framed out protocol, open, high, low, close. That means we're saying, hey, the range expansion for this week should expand. I mean, for this month should expand lower. But before it expands lower, we have to have some degree of manipulation. All right. And then we distribute and we come off the low after we distribute. Right. And then the candle closes. Okay. So very first week, trading up. Let's go to the days. All right. So right here, what we can see is we have not made it into the array. The draw of liquidity right here on the daily chart is bullish. Okay, so every single day that you were trading right here, you could be attacking previous day's highs, at least up into the array, because that that's where price is trying to get to. So that means protocol from an intraday perspective, open, high, low, close. I mean, open, low, high, close. Look at every single day, creating the low, right? So we start respecting the anatomy of a candle. Open, low, high, close. Open, low, high, close. All right. Now we've made it up to the array. All right. For our chart, because you've made it to the array, you're already thinking, you already told yourself that you're thinking about this monthly candle. You're thinking sell program from the open to the high, from the open to the high. All right. What do we look for in that sell program for the smart money reversal? What does smart money reversal really mean? What happens at the time of a smart money reversal? Can you guys place in the chat? True enough, but what happens from I guess maybe a more zoomed out scale? Because what does price have to do to even make it up to that point of smart money reversal? What are we saying about this right here? Order flow is what? Bullish, right? So the smart money reversal is the point at which the order flow, sell model. So here, the smart money reversal is the point at which order flow changes over. All right. So we're seeing, if you can look at this chart and you can see that these down close candles are supporting price, right? Price is attacking previous day's highs. These down close candles are all supporting price. All right. But then we make it up above that previous month's high. Okay. And then into the monthly fair value gap, we see rejection blocks form. We're already prepped and waiting for a reversal. We see rejection blocks, right? Remember, rejection blocks are bodies of candles are equal, all right? And then we see price respecting the wicks, all right? The bodies, what it's showing is that the point of where the bodies are, right? There's no volume being traded beyond that point, all right? So we get up here, and here is where we start to see order flow shift, right? Down close candles are taken. These up close candles start supporting the direction of price, right? You're seeing changes in the state of delivery created from up close candles. All right. Before we made it to the array, we didn't see that. So now we start understanding, all right, cool, we got our smart money reversal. All right. We had a little short-term high, intermediate, short term, right? We kind of got a swing high. Let's go to a daily and see if we have a swing high on the daily, right? Beautiful. 1, 2, 3. ICT, when he talks about that swing high, right? You got a high, higher high, and lower high. But what he talks about is that fourth candle trading below, right? Below that third candle. All right. Swing high after tapping into the array. But this is all with us understanding of where the draw should be, because this is a draw. The draw should be previous month's low. Okay, but we're only up here on the 4-hour chart. But you guys understand the draw is here. All right. We're looking at this and we're saying, oh shit, this is a market maker sell program. Original consolidation. You have your reaccumulations here. And then we just realize that, oh man, we have a smart money reversal. All right. So now the draw of liquidity is what? From an intraday perspective, what is the draw of liquidity every day that you come into price at this point? Previous day low. Exactly. Right. Previous day low. Perfect. Now, if the draw is previous day low, as the trader, in your mind, when you're thinking about a protocol, what does that protocol look like? Is it open low, high, close, or open high, low, close? Exactly, right? Open, high, low, close. Okay. So now that I know what the draw is, because I'm an intraday trader, right? I trade on an intraday basis. And I know where price is drawing to. Every single day, price has to take out a previous day's high or previous day's low. All right. Now there's some days where we trade inside of the range, like we do on these days here. All right. But primarily, price is wanting to attack the liquidity that rests above a previous day high or below a previous day low. Okay. So as you guys can see, every day right here, we saw that order flow change on the 4 hour, but now you can see clearly how that transitions into the draw being previous day's low, right? But more important, we're seeing open, high, low, close. All right, so let's look at this day right here and let's see where that high was created. So that day is Wednesday the 8th. And we'll look at the range as price, as price actually comes into that day. All right, let's go on a 1 hour chart. This would be actually that daily candle would start right here if we were looking at it. Let's go back. So we can look at this day here. All right, so this is just, this is a range. Very rare to see Friday take out, liquidity and then rally lower, right? But you guys can see what's happening in terms of that open, high, low, close, open, high, low, close, open, high, low, close. All right. Every now and then you'll get, as mentioned, you'll get a bar that trades inside the range. This is a key point. Catch this. When prices, like, where price is moving to, all right. When you have a day or an interval that trades inside of a previous interval's high or low, I mean inside the complete range of a previous interval. And I'm saying interval because this can happen on any time frame, monthly or weekly. When you have that scenario, right, you have to see this as like the accumulation phase of a dealing range. All right. What that means is there's a high chance that both sides, right, if you have an inside bar like this, there's a very high chance that both sides of that range are taken out. All right, especially if prices is trending. All right, and then you can see here, right, that's buy side being taken, and obviously sell side gets taken. So it's like, boom, right, you have a dealing range at that point. Okay, all right, but anyways, every draw of liquidity is previous day's low. Okay, open, high, low, close. And the overall draw, because we're looking at that monthly, right? It's this previous month's low, all right, the low of August. And you guys can see we make it down to the low of August. You can also see that the draw of liquidity from a weekly standpoint turns into the previous week's low. All right. Every single weekly candle is going open, high, low, close, open, high, low, close, right? We're attacking previous week's lows. Coming to the next week, right? We should be wanting to draw here. Okay. We hit the draw early in the week. Then we trade back into fair value gap. All right. We've met the fair value gap. Now, at some point, we should get back into attacking the lows. All right. So when it comes to framing bias, it's simply just understanding what side of the curve I'm on, right? What's that current state of order flow? And then to make it super easy, I can just take a data set, especially if we're trending, right? I'm going to take that data set and I'm just going to say, all right, where's the draw? Where's the draw been primarily? The draw has been previous week's low, previous month's low, previous day's low. I'm going to stick to that. I'd much rather be wrong following the more consistent protocol and price than trying to pick a top or bottom. Right. If I'm wrong, I adjust, I gather information, and then I plan for the next week to come. All right. But you guys can see here, prices attacking previous week's lows back and forth. All right. Every now and then you'll have a monthly array, right? We have this monthly array created, right? And then we have to trade for a period of time. We might look inside of here on the daily chart because we're trading up to that monthly array. We may look inside of here on the daily chart and see that draw has been previous day's highs, right? That's only happening because price is trading up to the monthly array, right? Once we meet that monthly array, then we should see it change over, just as we do here. All right. Does anybody have any questions? We'll open up the floor now for questions for you guys. I know you guys got questions. You guys have a lot of questions in the chat throughout the week. Questions or any scenarios? Anybody have a pair that they trade that we don't necessarily look at primarily? This is your opportunity to take a look at that pair. We can frame out bias. You know, we can try to make sense of what's happening within that pair. And if we're looking at EU right now, just to kind of go back over what everything that we covered, I'll allow you guys to formulate your questions if you have them. But if we're looking at EU, all right, and I'll say, hey, what is order flow on a quarterly chart? What I'm doing is I'm looking at this quarterly chart. I'm looking at the fact that these up close candles are supporting price, right? So up close candles supporting price, premium arrays supporting price. The reason I'm drawing that line there is because that is a mitigation block. All right. You guys can see, right? We have bearish range, market maker sell program forms, right? We're going stops, inefficiency, stops. Guess what? We reprice up to inefficiency. So my thought process is stops. Okay. This is a defined range. And we talked about the fact that market maker models form within defined ranges because price has to trade from discount to premium, premium back to discount. All right. So that's my inefficiency. That's my array. I have fair value gap accompanied with mitigation block. So what do you guys think? Yes.
Chris,
Yes,
I
sir.
have a question.
Okay.
How do you like, because we just got some info regarding the Model X, and is that a Model X consider a CSD itself? Like how, because it's a, if like swing to reversal day we are looking for us to know the order flow has been changed. Is there a possibility that when there's a swing to reversal but it's not actually a reversal, but you go back to the original order flow? Do you get what I mean?
All right. So I'm gonna draw out what I think you mean. You have it, you have an array right here. The day
Yeah,
starts
I have
here,
an array.
and then you're thinking, all right, this is a swing to reversal day.
Yeah.
And you're saying that
It
order flow
just
goes
turn again.
back and then goes back down again.
Yeah, is that possible?
Anything is possible because we don't orchestrate the market, so anything is possible. The only thing we can do is if we expected this, if this happened, guess what we'd be doing at this point? So watch this. If this happened, we had swing to reversal and that happened. All right. All we'd be doing as a trader is our only job is to take that low and that high, look within this range, find my PD array, right? If we have this type of move, maybe there's an imbalance in the range, right? If price comes down here and it never changes order flow, right? And it goes here, then this may have just been a short-term low. This is potentially my intermediate term low. Right? Any question beyond that? No? All right, cool. All right. So just going back to this, guys, as we're looking at this, just imagine starting here and moving here, what that state of order flow is. All right. So if I come down to a monthly chart, because we know that that fair value gap is up here, price is attacking previous month's highs, right? And it's only attacking previous month's highs to make it up to the premium array, right? But we're expecting smart money reversal. Why? Because order flow, higher time frame, is bearish. This is the range, and we're expecting the market maker sell program, right? The array here is where we want our smart money reversal to occur. So in the monthly chart, from the end of 2022, right, throughout 23, price is bullish. We're buying. We're thinking open every single month. We're thinking open, low, high, close, open, low, high, close, open, low, high, close. Every single week, not every week, but most weeks, we're thinking open, low, high, close, open, low, high, close. Okay, you guys can see here, we had a fair value gap, the opening. So let's go. Let's look at this scenario here. All right, think about this scenario right here, where we're attacking previous week's highs. We have a fair value gap. The draw of liquidity is previous week high. And now we're on the intraday chart. Right? We're thinking open, low, high, close. So that's Monday, right? Monday rallies, dives into the array. And I don't think we have a Tuesday low. But biggest point is the week opens here, right? We go under the weekly opening price, and then we're traveling back higher, right? Because we're thinking open, low, high, close from the weekly standpoint. And we know that the draw, right, the next overall draw of liquidity is right here, right? So now this is Thursday. And I'm not sure if the Friday of this week actually takes the high out, but we do understand what the next draw of liquidity is. All right, so Friday kind of BS is around. We get to the next week. We're thinking the same thing on the next week. We're thinking open, high, low, close. Doesn't have to happen like that. But by us saying open, high, low, close, all that means is when I come into that week, if the draw of liquidity has been previous week's high, right? I know I'm drawing these colors the opposite way, but if this draw has been previous week's high, I'm going to stick to that. All right. And so by me saying the draw is previous week's high, basically all I'm saying is the range expansion. All right. I don't care what the candle closes like. I just want to know every single week. I'm thinking, all right, what is the weekly range expansion? Weekly range expansion. All right, it's going to pull to the previous week's high. All right, cool. I don't care what that candle closes like. I just want that range expansion. I just want to know that we've made it to that draw of liquidity. That's what I was expecting. All right. Now, if you have a week like this where Monday just takes it out, it may be a tougher week to trade because now it's like, all right, I don't even have an objective anymore. All right, you don't know if it's going to trade back to the intra week high. All right, you can see Tuesday more of a Z day. What's this profile right here? This is a perfect teaching opportunity. What is this profile, guys? Yeah, blue boxes. Yeah, exactly. Yeah, swing to reversal, right? What's the key characteristic of this swing to reversal? What time are we making it to that previous week's high? Near reversal, exactly, right? Yeah, we're literally running into the previous week's high, right at the New York Open kill zone. So guess what? My anticipation as a trader, all right, and this is overextended, right? ADR is probably exhausted. ADR is exhausted. New York is opening at a premium rate, previous week high. At that point, I'm anticipating a swing to reversal. Right. This if you were to ask me what is how to know when you're gonna get a reversal, this is the more textbook scenario. New York opening at higher time frame liquidity pool. Right. Tuesday, Z day, right? Wednesday comes back, creates the low of the week. All right, and this is more of a swing to reversal where it's like London close, but it's kind of weird. All right, it's a little more unorthodox type of day. All right, this would be just a classic buy day. All right, but you guys get the point in terms of price attacking previous week's highs. All right, and then that attacking of previous week's highs transitions into previous month's highs. Guess what? We have not made it to the array. short-term high created. All right, now we run into the array. We're expecting smart money reversals. Oh, look at what happens. Make it into the array. Now we're attacking previous week's lows. Okay, you guys can see these down close candles as price is running up. These guys are being respected, right? Those guys are being respected. We go back up once more. All right, now the draw of liquidity. We run through the down close candle at this point. Right? We've really made it into the array. Now we've run through this level, right? This becomes a breaker. So we just saw a big change in price on EU. We were respecting these guys. Short-term highs engineered, intermediate, attacking nothing but previous week's lows. All right, we've just ran into a scenario now where, you know, price is consolidated because we're probably getting this pullback or this retracement. All right, I think we'll come right inside of this little fair value gap, and we're still inside of that breaker. All right, but you guys can see draw liquidity has been previous week's low. Monthly chart, draw liquidity has been previous month's low. Okay, we just have to see what price does inside of this array. But if you think about it, if this is a new candle, the draw, if the draw is previous candles low, we want to think open high, low close for the next monthly candle. All right, so seeing price move up here is perfect because that would create the wick, and then we draw back to the previous month low. Right, we just have something like this for this next monthly candle. This is where we have to frame out on an intraday. We have to frame all of that price action out, and then we have to see if we actually get a smart money reversal. So daily chart, all right, leaving the consolidation, 4-hour chart, all right, we'd be looking for that order flow to change over at some point up here, and we'll have at the end of the call, we'll speak about what I'm expecting for this week. Anything that changes from that is that we know today or likely open high low close on weekly candle back. Cool. Yeah, I like those moments. All right, questions, guys? All right. All right. So what I'm anticipating, I'll go ahead and put this out there now in terms of price, right? Because we saw a consolidation. We understand where we are in terms of order flow. We know this in this range. What I'm anticipating is that we draw back to that low. All right. If that doesn't happen, I'm fine. We just adjust. All right. But for right now, I'm looking at rejection block created after tapping into that fair value gap. Looking at a monthly chart, prices attacking previous month's lows. All right. I have a previous month's low here. Okay. I'm in the early part of a new month. I'm thinking open, high, low, close. I found my array. So here's my range. Here's my array. All right. So I want to do work from that array. Okay. Going down to a weekly chart. Actually, let's highlight the array. This is the monthly array going down to a weekly. All right. We know where we are. Not a lot to see on the weekly beyond the fact that we have this breaker. All right. Premium array. Looking at a daily chart. We can outline here. Here. All right. And I'm looking at here, right? Basically, all I've outlined is these are daily arrays that are in confluence with the weekly array, all right? The other thing I want to do is I want to outline the low of the monthly up close candle, all right? So these are all reference points that we should be mindful of, okay? What we can also do is go through our look back period, all right? And you don't need this as much. I don't use it as much. But when this is a time where I'll really use this when we get to a point where we've had a structural shift, a quarterly shift, or something of that sort, then and I start seeing a consolidation, right? It seems like price wants to kind of change hands for a bit. Then I'll go back and I'll look at those data ranges, the 20, the 40, the 60-day periods, okay? And you'll find confluences. So at this point, right, obviously we've run out the 20-day high, okay? And the 20-day low would be here. So we go back now from there, we go to our 40-day. Okay, so all of my raise within a 40-day period, all right, this would be my 40-day high. Okay, then we go back to 60. All right, now I don't believe we run above this high. All right, the 60-day high would be this candle. Okay, but I believe that this range is the range that price is accounting for. And the reason I say that is because this is you have a swing high here, right? We've taken out that short-term high and we rally lower. All right. So I'm thinking that the sweet spot for EU is right here where the low of that monthly candle occurs to this fair value gap. I think that's the sweet spot for EU. But we'll certainly be looking to see what occurs after we trade above 0.7680 and then 0.8. We'll just call it 0.880. All right. Yeah, and then so once again, 40-day highs here, all right, and then from this low to that high, right, these would be the 60-day arrays. So I want to see if we can rally higher and if we get some type of smart money reversal in here. So what we should be looking for as traders in here is we should be on our 4-hour chart. And remember this, guys, you don't have to catch the smart money reversal. Like you don't have to be wise guy and be super precise and catch this move. Why? Because guess what? We know that price is going to redistribute. Right. So you can be a little patient and you may throw 2 or 3 days of trading, right? Where you just don't do anything. Guess what? That one opportunity, that one swing to reversal day in New York, right? Maybe that's a previous day high. You get here, New York rallies, we open up in New York session, swing to reversal. Guess what? You know this is the low resistance liquidity run off that one trade. You got rid of all of the iffy 50-50 trades in here. You allowed yourself to see that order flow has changed. You waited for the perfect opportunity. You caught that one trade and you understand where the draw liquidity is. All right. So that's my approach as we're inside of here. Now, even though I'm saying, hey, order flow is bearish, if price starts to, and this is what I like to see, if we're opening up here for this week, I want to see price get inside of here. Right. This would create great buying opportunities because we know that, hey, these are key areas that price should come into. All right. So if we start to move down in here first, I'm looking at, this little range here. I'm seeing that OB, right? This is an old high, fair value gap. This becomes a sweet spot. So that means on a lower time frame, guess what? We want to see lower time frame market maker buy program, right? Maybe if this is a 4-hour chart, maybe 15, 5-minute market maker buy program. Or guess what? You don't even have to catch that smart money reversal. You can allow yourself to see, all right, smart money reversal, order flow has changed. I'm going to trade that little offset reaccumulation, right? And you know where price could potentially run to, right? But if I ask myself, hey, are we trading in the high resistant or low resistant scenario? We're trading a high resistant liquidity run at this point because order flow is bearish, right? And we're trading against the higher time frame order flow, but we know that price has a sweet spot. Now, as we start getting closer to that sweet spot, this is where you just back off and you say, all right, I'd rather see 4-hour order flow change over and then get engaged to go back short. And if it never goes back short, we adjust and hey, we trade to the top of the range. But I don't think that happens. I think we've left too much this slow resistance signature, right? This is like screaming at us. So I think we're just seeing a market maker sell program form, and then we come back down here. Okay, but the moment we get somewhere here, it's like game on. We should be seeing previous day low attack, previous day low attack, previous day low attack, right? And as a trader, we're coming to it, open, high, low, close protocol. Open, high, low, close protocol. Okay, back to that previous month's low. So we're in a, if price remains bearish, right, we're in a great scenario because there's a lot of opportunity, right, to trade back down to that 0450 to 0400 level, which is 0400 is our monthly inefficiency down here. It's really 03800. Look at pound USD. All right, so pretty much the same idea in terms of pound. I'm looking at this here as a breaker. Rejection blocks form off of that area. All right, price goes into obviously this is a smart money reversal. Price starts attacking previous month's lows. Okay, so the protocol for this month of November, right, is open high, low close. What are we doing? We're opening. It goes under the opening price just a little bit. Why? Because it needs to accumulate loans and discounts relative to the opening price so that it can get back higher. Right. So we'll reference this down close candle in here. All right, we're looking at a weekly chart. We see that fair value gap aligns with the opening price of that down close candle. All right, so this may be a sweet spot for us. GU may be a little easier to read because we have a very clear inefficiency on a weekly chart. Also aligned with this weekly breaker. Daily chart. Price has been attacking previous day's highs. Why? Because we're just making it up into a higher time frame array. Right? So as a trader, our sweet spot is up in here. What are we looking for in here? For our order flow to change over, previous day's lows to start being attacked. All right, now we understand we're on the sell side of a curve, and we can have an open, high, low, close protocol trading the low resistant liquidity run. Okay, so patience in here. All right, if we open the week up, right, we have a gap for the week, or we open up here and we start to trade lower in Asia, right? You should be looking at this range from low to high, and you should be mapping out areas of interest. Okay, what I can see is a mitigation block here. You can also reference this as a breaker because we go low, we attack the low, and then we rally. All right, or you can say here, fail to attack this low, and then we rally. All right, so that becomes your mitigation block. But opportunities for buying are only if we move here first, then here. If we move here, then I'm not concerned with buying because we've already met the objective. All right, so I want to see price come here. That means we have opportunity to get back up to this point. All right. You guys can see also low resistance signature down below the low. That's previous month's low is what I believe will attack. And I think that we'll come to the bottom of this range. That could be an entire year from now. It's literally taking us 1 year to go from here all the way up here. So we can see the same thing. Unless we just get speed back down to that low. Yeah. That's all I have, guys. If you guys don't have any questions, we'll wrap it up.
Chris, I have another
cool
question.
Oh, okay. Let's do it.
Yeah. Do you do we have a point of reference that say what happened that when do we know that we are not actually in a sell program? Like this actually it's going to retrace deeper or just like go straight to the to the bull market again.
So you'll know
Like
that by if so remember when we zoom back out, higher time frame, order flow is what is order flow right here? It's bearish, right? You're seeing up close candle support price.
yeah.
All right. So, you know, we're in a bearish range. However, if let's say like what you're asking is like how do we know if we're what was that first part of the question again?
Because now we are anticipating a sell program.
Mm-hmm.
So we are expecting some reversal on the major arrays. So at which point, how much does it violate the premium PD array
Mm-hmm.
before we can consider it will no longer be a sell
Bearish.
program?
Yeah,
Yeah.
I got you. So just it's simple. If we get into the array, right? That's why I say patience, right? Because we can't just say, oh, it's made it to the array. Now let's start short. Nah, can't say that. If that order flow, if we continue to see down close candles create CSDs, then I mean, and then we let's say we trade here and we close that fair value gap. So we might trade here and we have a scenario where we get here, we close that fair value gap. All right. Well, then we might start attacking that fair value gap. All right. We get here, we close that fair value gap. Order flow in that 4 hour chart never changes back bearish, right? It just continues to be here, right? Order flow, bullish, down close candle support price. And we close this guy in also. So at this point, we might start saying, all right, we may be trading back to the top of the range. Why are we saying that? Because price has had no regard for the fair value gaps. All right. So it's not a matter of how do I know that we're no longer in the sale program. It's even if you thought it was a sale program, or if you thought that price should get back to the sell side of the curve, what's more significant is you waiting and allowing yourself to actually see if it has transitioned to the sell side of the curve. All right. If it never does, at some point you realize that it never does, and you start attacking what that draw liquidity is, that previous week's high. All right. But obviously, I'm not going to be a buyer as we get into this higher time frame fair value gap. Like I'm not going to be on the intraday chart buying into this. It just doesn't make sense. I'd much rather, take the day off, see if order flow starts to change over once we get inside that area. Does that help out?
Yeah. I think
Okay.
I can understand that. Thank you for the reply.
Yep. No problem. I'll check the chat. All right. At which point from the daily chart do we know that there will be? Oh, is that what you just asked? Was that
Yeah, that was the same question.
Okay. All right. On the 3 month, I was thinking that EU was in a market maker buy model, and hence was thinking that we are probably in some for the price to move higher. Am I wrong? All right. Can you speak up? Jay? Is it Jay?
Yeah,
Let's
it
chat
is.
about
It
this.
is. Can you hear
Okay,
me?
cool. Yeah. I can hear you. Good.
Yeah,
All right.
perfect. So on the 3 month, I kind of saw that EU is on a market maker buy model because the lows of it is not getting taken out. So I was thinking that, okay, probably we've created the low and then maybe there's one more short-term low that gets created and the market might go up.
Okay. So you're saying all right. So from the quarterly perspective, are like what side of price are you looking at this stuff down here?
Yeah, I'm looking also the price to the left of the chart, whatever you're saying.
So like
Yeah,
at this
much
stuff
more
over
left.
here?
Yeah, exactly. So
Okay.
what I was thinking is price came and tapped onto this fair value gap here, and then probably this is the intermediate term low, and then we're going to put one more short term low, and then it's going to reverse. Yeah, exactly. That's what I was thinking.
Yeah, that's that. Hey, look, if the new perspective like changes my mind, I'm all for it. But that is actually a really good way to look at it. And now that I look at it to support your case, right? We're seeing this is more so buy side of a curve, all right? And this is just price pushing down into that array. Let's look at a 6-month chart. That's a really good analysis, right? If we look at a 6-month chart and we take this range, right, then this would be price going from point A to point B. Array would be the order block to fair value gap, right? And then potentially to point C, right? So that, honestly, that is a great way to look at it. Now, what I will say is I think for us to officially see ourselves get back in line with that. And one thing I do like also is with that analysis, right? Is and I looked at this at one point in time, but I never really saw it this way, which I honestly like this way that you pointed out. That's a very great observation. But I'm also looking at these huge rejection blocks on the 6-month chart. All right. No volume down inside of this area. But I think what we need is, because when I look at this 6-month chart and I'm looking at order flow, right? We have to take the mitigation block here. I can't really confirm truly, at least if we trade above this point, then I can say, all right, we're going to 16,000. All right, but I think right now we're just it's a tough call because we're kind of inside of this range. But that's a very, very like a really good analysis. I like that. I have to look more into that on my own personal time to kind of make a lot more sense. But I kind of like that analysis a little better than mine because I'm looking at the fact that price is creating, additional highs and we have this low resistance signature.
Thanks, Chris. And I have one more question.
Mm-hmm.
What exactly is the OTE that you're saying? Is it the level of fair value of the balanced price range?
So are you asking when I mentioned the term OTE?
Yeah, because as far as I know, ICT has some kind of fib levels on,
Yeah.
yeah,
So
that's
OTE just means optimal trade entry. All it, just so that we don't complicate it, all that means is there's a range created, right? Here's my range, and then I'm expecting price to come back into discounts to that range to some type of a rate before turning around. So he's saying that this is the optimal point of reference for price, down between 62 to 79%. All right. But a lot of times when you hear me reference OTE, right, it could be to the extent of just equilibrium. It just means retracement continuation. That's all it is.
perfect. Thank you.
Mm-hmm.
Hey, Chris.
Yes, sir.
I would like you to frame bias for NASDAQ 100 if you can, please.
Yeah, let's do it.
Perfect.
I haven't even. Is it still in that range? I know like 2 weeks ago it was in like a huge range. What feed do you use? Do you use this index CFD?
Any, to be honest. Yeah, that will work as well. It's just broke highs with the news that came out.
All right, does this look okay?
Yeah.
All right, cool. All right, so obviously I know that we're in a. Why am I not getting the rest of the price action? All right, so obviously we're looking at this, we're bullish. I'm seeing these as relatively equal highs. All right. We've traded down into fair value gap. Right, we can see a swing low, short-term low, intermediate, short-term, right? So swing low has formed off of that fair value gap. Now we're attacking quarterly highs, right? So here's that quarter. We're attacking that quarterly high. So for the next quarter, what should you be thinking? Open, low, high, close, right? Now you can see this would be the discount array. Okay, so let's mark out that discount array, right? So now we can go to our monthly chart. from a monthly perspective, price is attacking what? Previous month's highs, right? Here, 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 here. Draw of liquidity, previous month's high. Every single month, open, low, high, close. Right? Now we just have a little bit of a retracement. Retracement to what? Probably to the extent of this fair value gap. Right? And then we also understand that this is a quarterly fair value gap that we're also tapping into. Right? So as a trader, we should be looking at this range from here down into here, seeing this as a sweet spot for a potential smart money reversal. Okay. And I like to frame that actual change in order flow on a 4-hour chart. Like once we make it into the array, right? Seeing the 4-hour shift and then seeing like, all right, a previous day high was then taken in line with the 4-hour shift in order flow. That kind of lets me know, all right, cool, we should be trading back to the highs. All right, but if I'm looking at this here, this looks like a buy program. It looks like we've engineered these short-term lows. We've run into that short-term low intermediate. We can look at this as a dealing range. This is going to be a breaker when I zoom in. So now we have a breaker, right? So if I'm the trader and I'm coming into a new week, right? At this point, I'd want to think open, high, low, close. Like we just swept this liquidity, tapped into that weekly inefficiency, okay, and we created a change in the state of delivery, right? So this is an order block at this point. All right. So going to my daily chart again, we can kind of say the same thing, right? You can see the imbalance. Look at the giveaway here. We tap into the array, and what happens? The imbalance, right? Price closes that imbalance. That lets us know, all right, opposing stop run. Right here, we tap into the fair value gap. We went lower. Now we tap into the higher time frame array. This is the same stuff we've been preaching, right? Since day one. Stops, efficiency. Stops into higher time frame array, smart money reversal. Now we're going stops. We're saying screw the inefficiency because we want to trade stops. Stops to stops means dealing range. So as a trader, your sweet spot, if I'm coming into this week, I'd want to see price create a lower time frame buy program into here. All right. Because you're trading at this point, I would consider buying the low resistance liquidity run, relatively equal highs here, right? Low resistance signature here. I think that 16,000 is near-term draw, and then more longer-term draw would be 16780. All right, but the key point would be to look for price to push into discounts and allow yourself to confirm some type of change in order flow. The overall draw.
When you do your bias about like what sort of pairs that you trade, how many confluences do you use? Because we've been learning like a lot of stuff like dealing ranges and short-term highs and lows. Do you consider all the facts together and like frame something off your own, or you have like a set specific list? I know you're gonna go that into the entry models later down the line, but still, if you could give me like a gist of how many things do you consider to actually place a trade?
So before I actually execute?
Yeah.
So sorry. So let's give you a scenario. All right. So at this point, we framed out narrative and we framed out bias. We understand the overall outlook. We've answered that question. That's 50% of our job. All right. Now, the next thing that I want to do is, because I understand that, hey, I'm expecting open, low, high, close for this week. What I'm going to be doing is I'm framing out, I'm looking at this range. All right. And I have to go through my discount arrays. Where are my discount arrays? I have a breaker, I have a fair value gap. All right. So for me to execute, right, I may, if order of operation is everything. All right. Let's say I'm trading, let's say you're trading, I can't say London session because obviously, I wouldn't trade London session for indices. Not saying you can't. But let's say that if I'm looking at this I understand right away that the highest probability scenario for me would be to buy, right? And if it's going to be to buy, it would be to buy at a discounted rate, which would be here. All right. However, that doesn't mean that I have to wait on this. I can, but if I saw a price take out a previous day's high, let's say like opening bell took out previous day's high, and then got back inside of the range, right? And I saw the lunch period coming back up, like I say, 11 a.m. Okay, and we'll speak about that 11 a.m. window for indices. But let's say we saw that scenario looks like this, right? Opening bell, we take out a previous day's high. I understand that it's Monday, and I want to see price get into the under the weekly opening price into the discounted rate. I can potentially short, right? Low hanging fruit to that point. Okay, so I see us come off the high, we trade lower, we go into the lunch period, price starts rallying higher, because typically in indices, you'll see the lunch period will attack like an AM session high before the continuation. Oh, it's like an OTE scenario. All right. So we're coming back up. We take out an AM session high here. All right. Fair value gap, OTE, and OTE scenario. Now at this point, I'm looking at price inside of that fair value gap. I'm on a lower time frame, and I'm now looking for Model X. All right. So everything else is complete. I understand narrative. I understand bias. I understand where price needs to go. All right. We need to move from this point and travel a little lower into the discount rate. All right. So when I'm up here on the intraday chart and I'm looking at NAS, I'm looking for that sweep in the stop point leg, right? We get the imbalance is negated, the order block is validated, right? We trade back into the order block, and then that institutional order flow is confirmed. All right. I'm not going into the fine detail because we'll save that for next week. But that is the thought process. It's always, I understand bias, I understand the draw. Now I can frame out narrative. All right. I may be coming into this week thinking about a Tuesday low of the week. So I want to see price rally, get its way to that point. So I can short to that point. Because then the major buy, the low resistance liquidity run to buy or the midweek reversal will come from that array. But when it comes to execution, it's always define my range, define the PD arrays within the range, allow price to trade to the PD array. Now I trade the response at the PD array. All right. And Model X gives you the highest probability in terms of being able to pinpoint if and when price is actually turning around. And that's why I say when we execute at the point of speed. Literally, like the moment we execute, speed should come into the market. Once you guys really perfect this, you'll see that when you are wrong, right? And a lot of times we won't really be wrong about direction. We'll probably be the times you'll be wrong will be being wrong in terms of price may want it to make one more high and then drop. All right. But you'll be proficient in terms of direction. But when we are wrong, right, instead of giving us that speed, we'll see price kind of hang around. Right. It may go here one more time and then boom. All right. And I'm gonna teach you guys a mechanical way of basically cutting the quote unquote thing, cut your losses short, right? Because a lot of this just becomes of mitigating your downside. I'm going to show you guys how you can manage this next week. I'm going to show you how you can manage this to where the numbers will play out in your favor over time. Does that answer your question in terms of how I would approach it?
Yeah. Thank you so much, Chris.
Okay. Any additional questions?
Just a quick one, really. So
this actually.
Can I ask you a question?
What was that? Yeah, sure. Go
Yeah.
ahead.
So basically, like you made me understand like what steps do you actually look for, once you have understand the bias, the draw, the narrative. And then, like a lot of times in NASDAQ in particular, everything would align, like if I want to trade something, but then the sort of entry that I'm looking for is, falls out of the hours that it's supposed to. Would you, as a person, still take a trade if it's after half 4?
Nope, because what happens at that point is you leave room for things to be judged based on your emotional discretion, right? Because now it's no longer mechanical. It's more, I don't want to miss the trade, so I'm going to jump inside of the trade. Which is the moment you do that, you completely remove any type of mechanical nature from your system. So you got to be willing to throw trades or cease. You know how many times I know where price is going and I don't get an opportunity? Like, there's a lot of times where I'm calling the draw, but that doesn't mean I'm getting an opportunity because we as traders we think because the market is always in motion that we should be taking a part in every single opportunity. And the illusion is that you need to trade every opportunity to be profitable. You can go through an entire month, take 2 trades. Those trades might hit 3.5 R a piece. That's 7 R. That might be the only 2 trades you took that month. That's 7 R. Right? So once we get to the point of in the mentorship where we say, all right, cool, hey, you trade indices. All right, this is the most consistent way to trade indices. This is the most consistent thing to wake up and look for in terms of indices. All right, and we're gonna show you that, and you'll wake up and you'll look for that scenario every single day. You might find once you back test, you might find that scenario on average shows up 4 to 5 times a month. All right. But where you grow as a trader is you realize those 4 or 5 times are all you need. You can jump in there and battle with trading every single day, right? And then by the time you look back at the calendar for the month, you might have saw, damn, I could have just taken those 4 or 5 trades, or even two out of two of those trades, and still had a great month. So it's not about the quantity; it's about the quality. So there will be times where you know where price is going, but it just didn't give you your system. What session do you trade? You trade PM session, AM session, or do you just you just show up?
New York Open, preferably.
Okay, so AM session for indices. Cool. Yeah. So yeah, you'll see. I'll show you a very like consistent way. It is basically just understanding like the easiest way to trade is to trade continuation. Right? Things get a little harder when you start picking tops and bottoms, and that's just trading reversals. All right. But if I can wake up every day and find an expansion and find some type of fair value within that range or find some type of PD array within that range, the odds of me taking a trade going back in that direction are a lot higher than me seeing that expansion and trying to pick the top. Right? I may see something like this and then boom. Now I just got taken out because I was trying to pick a top. So when it comes to indices, waking up, looking for that expansion, what you guys will notice, and this is me, I'm not trying to get you to focus too heavily on something that we're not on just yet, but for indices, a lot of times during that lunch period, price, if there's been an expansion in the AM session, during that lunch period, that's where you'll see price will come back to kind of liquidate an AM session low, higher low, and then continue. So if I'm trading indices every day, I'm waking up looking for an expansion. Then I want to mark out that 11 o'clock period. And yes, I know lunch in New York is 12, right? But for the sake of this, right? And this is not me creating anything. This is ICT's teaching. That 11 o'clock period, you'll see price come back, liquidate an AM session higher low, right? And then you'll get that extra continuation. All right, it's just like an OTE scenario. All right, you can kind of see it here. Lunch period, we're liquidating this low from 11 o'clock, but then it continues higher. All right, and so what that does is when you wake up and you see, all right, there's no, you're looking from 9:30 to 11, and you see, hey, there's no expansion. Do something else for that day. All right, and if you go from 9:30 to 11, and you see, all right, cool. Oh, from opening bell to here, right? This would be, yeah, it's opening bell, right? We take out liquidity and then it rallies lower. Guess what? Still have that low open. And what time is price coming back inside of the range, right? Closer to 11. All right, but OTE, then continuation. So you set yourself up to look for the same thing each and every day, just like this right here. Expansion, all right? And then right here is 11 o'clock. At 11 o'clock, what's happening? We're taking out an AM session high. For what? Continuation. So right there, you remove any type of emotional discretion, right? You don't want to have oh, well, I feel like this today, so I'm going to take the continuation, or I'm going to take the reversal. No, just add a very mechanical approach. Look, expansion, right? What time are we coming back inside the range during that 11 to 1 period? We're attacking the AM session. This may be lower time frame AM session levels, right? Biggest point is I can take that range. This is a breaker. This is a dealing range. I'm just playing for continuations. So if I'm trading indices, I'm playing. I'm not even showing up for the AM session. I'm allowing the AM session to play out because I want to see expansion. Because the easiest way to trade it is just to take the continuation. I don't have to play around and be a wise guy and catch the most precise reversal. I don't need that. I might get 4 continuations for that month. Each one may give me 4R. If you're very proficient at applying Model X, right, you'll make that happen. Right here, here's 930. Guess what? Once we get to 11, all right, so we go, this is 930 here. We get down here is 11. So guess what I'm doing at that point? I can trade this. Now I'm looking at my AM session highs, and I want to see if price gets here, if Model X doesn't form, right? Which I'm sure it doesn't, because I can look at this very first candle. If Model X doesn't form, right, you don't take the trade, right? Price just keeps going that way. It didn't give you that continuation for that day. Right? This is a day where you probably wouldn't even want to trade it, right? And you'll have to get used to looking for your model. You're not looking for trades. You're looking for your model. Right? If you're looking for trades, you're just going to trade every single opportunity, every piece of stimuli that shows up in the market. You're going to trade it. There's going to be no consistency within your results. But we'll get into that. I promise you, you guys will know immediately as soon as you wake up, this is what I'm doing. And it'll take some time to trust it because your ego will say, no way you're going to let that trade get away from you. And it's not about one trade. It's about a consistency of trades. So yeah, if you guys don't have any more questions, we'll wrap it up. We're about an hour and 45 minutes. Next week, as mentioned, next week we deep dive into Model X and really talking about the change in state. Show you some things on a 5-minute chart, also with CSD, and then we push into trading plan development. So I thank you guys for your time, and yeah, I'll see you throughout the week. Thanks,
Chris,
guys.
what's the homework for this week?
What was that? Homework? Cool.
Yeah.
So for homework, what I would like you guys to do, we had, and this went well for the previous boot camp, is create a 3 to 5 minute video breakdown. So you guys are going to actually talk to the same way I do on those weekly outlooks. Create a 3 to 5 minute breakdown of your asset, whatever asset you trade, and let's start on the quarterly chart. And let's basically break price down from top to bottom. Start on that quarterly chart, defining order flow. I'll place it in the chat. I'll write it up for what to do. But you're gonna basically create a 3 to 5 minute outlook for this week for your particular asset that you trade. And you should be basically answering those key points that we went over earlier in the introduction. But like I said, I'll put them in the chat. All right. Cool. All right, guys. I'll see you throughout the week, and then I will upload this recording as well.